For decades, Porsche was the company every other automaker quietly envied, not for its cars alone, but for its margins. While mass-market brands fought over 3 to 6% profit margins, Porsche routinely banked over 14%, an almost unheard-of number in an industry built on razor-thin returns. In 2025, that number collapsed to 1.1%. Group operating profit fell 92.7%, from 5.64 billion euros down to just 413 million. And inside the automotive division specifically, the division that actually builds and sells cars, operating profit didn't just fall. It nearly vanished entirely, dropping 98.3% from 5.3 billion euros down to 90 million. To put that number in perspective, Porsche's core car business made less profit in an entire year than some single luxury dealerships' turnover and inventory value in a few months. Group revenue for the year came in at 36.27 billion euros, down 9.5%, while net profit after tax dropped 91.4% to just 310 million euros, compared to nearly 3.6 billion the year before. Behind those numbers sits a 3.9 billion euro charge that Porsche itself broke down into three distinct pieces. 2.4 billion euros in what the company called realignment costs, essentially the price of reversing course on its own strategy, 700 million euros tied to winding down battery-related operations, and another 700 million euros absorbed directly from new US import tariffs. Three separate financial wounds, all opening at the same time. On a company that built its entire brand identity around precision and control, the stock market didn't wait for the full annual report to react. Porsche received 4 separate profit warnings over the course of the year, and its share price lost more than 30% of its value, a decline severe enough that Porsche was removed entirely from Germany's top DAX stock index. A genuinely humbling fall for a company that had gone public in 2022 at a valuation reported near 75 billion euros, one of the largest European IPOs in years. So how does a company this dominant, this profitable, fall this far, this fast? The honest answer isn't one single mistake. It's 4 separate crises that all hit simultaneously, each one making the other significantly worse. Start with China, because this is where the story really begins. For years, China was Porsche's single largest market by volume, at points accounting for close to a third of the company's total global sales. That market didn't just soften, it collapsed. Porsche's full-year China deliveries fell to just 42,000 vehicles, a 26% drop in a single year, and China's share of Porsche's total global deliveries fell from 18% down to roughly 15%. Global deliveries overall dropped 10% to 279,000 vehicles, and even Porsche's home market of Germany wasn't spared, falling 16% to 30,000 units. The reason China collapsed isn't complicated, once you look at what's actually happening in Chinese showrooms right now. Domestic Chinese EV makers, companies like BYD, NIO, and Xiaomi have spent the last several years building electric vehicles with genuinely advanced software, large in-car displays, and rapid over-the-air updates, all priced at a fraction of what Porsche charges for comparable performance. Xiaomi's SU7 in particular became a cultural phenomenon in China, posting serious sales volume and track times that stood toe-to-toe with performance cars costing several times more. When Chinese buyers, especially younger, tech-forward buyers who are increasingly the ones driving luxury purchasing decisions, started comparing a Porsche's infotainment system and software update cycle against a domestic EV's, Porsche's century of engineering prestige didn't automatically win that argument. The German brand's badge still carried enormous weight in gasoline performance cars. In the software-defined EV space, it was suddenly competing against companies that had built their entire product around exactly that comparison, and building it cheaper. That competitive pressure fed directly into Porsche's second major problem: what actually happened with its own flagship electric vehicle. The Taycan, launched in 2019 as Porsche's first fully electric model, was widely praised for its driving dynamics when it debuted, and as recently as 2023, it sold more than 40,000 units, up 16.7% year over year, genuinely strong numbers for a niche electric performance sedan. But the Taycan has also been dogged by a persistent, serious reliability problem: its high-voltage battery packs. The U.S. National Highway Traffic Safety Administration issued recalls covering 2020 through 2024 Taycan models over a specific defect, faulty battery cells that could short-circuit internally and increase the risk of fire. In one wave, Porsche identified 936 vehicles showing what the company called anomalies in their battery modules, requiring module replacement, while thousands more vehicles needed inspection to check whether they were affected at all. In total, recalls tied to this exact battery short-circuit issue covered more than 27,700 vehicles, and Porsche's own guidance to owners in the interim was blunt: limit charging to 80% capacity until the repair could be completed. A stopgap workaround, on a car that costs more than most people's houses, is not the kind of headline a brand built on precision engineering once attached to its first ever electric flagship. Combine a real reliability problem with Taycan deliveries actually falling 22% in 2025, and you get a flagship EV that was supposed to prove Porsche could dominate electrification, instead becoming one of the clearest signals that something in the strategy had gone wrong. And when a car isn't selling and isn't fully trusted, the traditional playbook is to discount it and clear the lot. Porsche did exactly that, reportedly slashing prices significantly across parts of its EV lineup to move excess dealer inventory. For a brand whose entire pricing philosophy has always rested on scarcity and restraint, a Porsche is never supposed to go on sale. That kind of aggressive discounting isn't just a short-term inventory fix. It's a direct hit to the exact brand positioning that justified the premium pricing in the first place. Every discounted Taycan sitting on a dealer lot with a marked-down price tag quietly told existing Porsche owners and prospective buyers alike that demand wasn't what the company had promised. Then came the supply chain disaster that turned a strategic wobble into an outright crisis. Porsche's electrification plan depended heavily on Northvolt, the Swedish battery maker that was supposed to become Europe's answer to China's dominance over battery cell production. Northvolt filed for bankruptcy, first in the United States in late 2024, then formally in Sweden in 2025, after burning through billions of dollars without ever reaching the production scale it had promised. For Porsche, this wasn't a minor supplier hiccup. Porsche had made a specific, risky bet, single-sourcing the battery cells for its upcoming electric 718 Boxster and Cayman models entirely from Northvolt. Because those two-seat sports cars have almost no spare room for oversized battery packs, and Northvolt's cells offered the high energy density in a small enough footprint to make an electric 718 physically possible at all. When Northvolt collapsed, that single-sourcing bet collapsed with it, forcing Porsche to delay the electric 718's launch, first from 2026 to 2027, an ongoing postponement without a fully confirmed replacement supplier locked in. The fallout didn't stop at delayed launches. Porsche had also built its own battery subsidiary, called Cellforce, specifically to develop next-generation high-performance cells in-house. With Northvolt gone and the broader battery supply landscape shifting rapidly in China's favor, Porsche made the call that in-house battery production was, in the company's own words, not economically viable. Roughly 200 of Cellforce's nearly 300 employees were let go, with some offered positions at Volkswagen Group's separate battery subsidiary instead. Porsche wrote off hundreds of millions of euros tied to the entire effort. An ambitious plan to control its own battery destiny, insulated from the exact kind of Chinese supply chain dominance that was simultaneously eating into Porsche's China sales, ended in job cuts and a write-down less than 3 years after it began. All of that pressure eventually reached the boardroom itself. Oliver Blume had led Porsche for 10 years, and for the past 3 of those years had simultaneously served as CEO of parent company Volkswagen Group, an unusual dual role that investors increasingly criticized as both companies underwent painful restructuring at the same time, a level of strain that some argued no single executive could properly manage across 2 major automakers at once. In October 2025, Porsche's supervisory board announced Blume's replacement, Michael Leiters, effective January 1st, 2026. Leiters wasn't an outsider brought in to shake things up cold. He'd actually spent 13 years at Porsche earlier in his career, from 2000 to 2013, including serving as project manager for Porsche's very first Cayenne hybrid, before leaving to become chief technology officer at Ferrari, where he helped develop hybrid supercars like the SF90 Stradale, and later became CEO of McLaren Automotive. His entire professional identity, in other words, is built around hybrid powertrain expertise, not pure electrification. And that background tells you almost everything about the direction Porsche's new leadership intends to take the brand. That direction became clear almost immediately. Porsche has quietly abandoned its once ambitious target of having 80% of its lineup fully electric by 2030, pivoting instead toward a flexible mix of gas, hybrid, and electric models, with no fixed timeline forcing the balance in any particular direction. Key upcoming vehicles, including the electric 718 Boxster and Cayman, and the flagship K1 electric SUV, have reportedly needed significant re-engineering to accommodate combustion and hybrid powertrain options that weren't originally part of their design, rather than shipping as pure electric vehicles as first planned. And the retrenchment goes well beyond product strategy. Porsche has announced successive waves of job cuts, roughly 30,900 positions by 2030 through previously announced restructuring, plus additional cuts on top of that, with around 2,000 temporary positions already eliminated. Given that Porsche employs approximately 40,000 people worldwide, the scale of these combined reductions means significantly more than 10% of the company's entire global workforce is being eliminated. In a further sign of the company pulling back from ambitious side projects to focus purely on stabilizing its core business, Porsche also announced it's selling its entire ownership stake in hypercar maker Bugatti Rimac, handing full control over to Rimac Group and its founder Mate Rimac, a partnership that once represented Porsche's boldest bet on the future of ultra-performance vehicles, now quietly exited entirely. Looking ahead, Porsche's own guidance for 2026 suggests the company expects a partial recovery, but not a return to its old dominance. The company is forecasting group revenue between 35 and 36 billion euros, roughly flat compared to 2025's already reduced figure, with return on sales expected to climb back into a 5.5 to 7.5% range, a meaningful improvement from 1.1%, but still nowhere near the 14.1% margin the company was posting just 2 years earlier. Porsche has also explicitly warned that further extraordinary charges, albeit smaller ones, are still expected in 2026, and that total vehicle deliveries will likely fall below even 2025's reduced levels before any recovery takes hold. What makes this story matter beyond one company's balance sheet is what it actually reveals about the entire premium automotive industry's electric vehicle assumptions over the past 5 years. Porsche wasn't a reckless startup chasing hype. It was, by every measure, one of the most disciplined, most profitable car companies on the planet, and it still badly miscalculated how fast Western consumers would embrace electric vehicles, how aggressively Chinese manufacturers would out-execute on EV software and pricing, and how fragile a newly built European battery supply chain would prove to be the moment real-world production challenges hit. If a company with Porsche's engineering pedigree, brand loyalty, and financial discipline could get this wrong, badly enough to erase 93% of its profit in a single year, it raises a genuinely uncomfortable question for every other legacy automaker still betting big on an aggressive, fixed-timeline electric transition. Are you certain you're not making exactly the same miscalculation right now, just a year or two behind Porsche on the same collision course?